Good afternoon. We are now looking at Rsk4805, and with Rsk4805, the main idea is to look at market risk, right? So the main idea with Rsk4805 is to look at market risk. So when you look at market risk, the curriculum changed last year from what it was previously, because previously, when you look at RSK4805, which looked at market risk, it was just looking at derivatives. So it has become a bit more comprehensive, where it's basically looking at market risk more on a practical case, and also from a perspective where you are comprehensively assessing the market risk, not only looking at it from market risk emanating from derivatives as well. So when you look at market risk, so which means for the curriculum, we're going to be looking at market risk more comprehensively as well. So my advice would be, if you check on the material that the lecturer have posted for market risk, you will see that there is a study guide that you're able to download, which is usually, I think it was in PDF, it was in Word. I'm not sure if they converted it to PDF format as well. And in the study guide, there's 9 study units as well. But those 9 study units, they are different chapters which fall under each study unit as well. So some study units, they just have 1 chapter, and some of them have a couple of chapters that they expect you to cover within the study units as well. So it's highly advisable that when you are going through the curriculum for RSK4805, you try as much as possible to stick to the study guide. Because the study guide that the lecturer gives you, it would ensure that whatever material you are going to be covering in the textbook, we are going to be covering the relevant material. Because some study units, they even give you to say, from this chapter, cover certain section, from section this to section that as well, so that you don't have to end up doing things that are not in the curriculum as well. So please try as much as possible to stick to the study guide that the lecturer would have made available to you. Now, when it comes to RSK4805, you will see that we should expect the lecturer to give you about 5 assignments, which will make part of your coursework as well. So don't stress much about the assignments. And remember, the lecturer, they will give you the assignments as and when we go as well. So whenever the assignment is made available, we'll try as much as possible to assist you with the assignments. Where there's a need, we'll do the assignments in class. It will depend on exactly how they structure the assignments as well. So, and also they'll try to shuffle the questions in the assignments. Don't worry much about it. What we usually do is that we create a template of the questions that we would expect in the assignments. Then when we assist you with the assignments, to be based on the template of the different questions that would be asked in the assignments as well. So for the assignments, don't stress much about them. We'll deal with them as they come as well. But we'll make sure that we give it enough time to do the assignments or assist you with the assignments way before the due date, so that you know that you don't have to wait until the last day or the last week to do the assignments as well. Although they'll give you the assignments as and when we go. So remember what I said, there are 9 study units that you are going to be looking at for RSK4805. And please, most importantly, try to stick to the study guide that the lecturer makes available as much as possible, so that you don't go off the tangents and study things in the textbook which you are not expected to study as well. Our plan is that between now until the end of October, we should be going through the curriculum, and we should be done with the curriculum as well. We'll see and assess how we go. If we need to add another additional class, we will definitely add another additional class, so that no matter what happens, by end of October, we should be done with the curriculum. So this will ensure that in November, December, January, and if you write in February, you will be able to access what we'll be doing with revision, where we are looking at material for revision as well. And please take note, your schedule for revision is a bit different from the schedule that you have or expect for going through the curriculum as well, because during the revision period, especially after the Christmas period, we are going to be giving enough time. It will no longer be once every second week. Generally, it's going to be longer classes, and they will structure it in such a way that you will dedicate as much time as possible to do the revision and polish up on the different concepts as well. Now, remember, the past paper questions from 2019 going backwards, they are not relevant. They are not of much use to you because previously in the previous curriculum, they were looking at derivatives and going in depth with derivatives. Now market risk is a little bit different, and because of that, don't look or use past papers from 2019 going backwards. The only paper that would deem to be relevant to you guys is the paper for the February 2021 paper. So the February 2021 paper is the one that we deem to be relevant. So what we'll do is that we're expecting that during the revision program, we will be having the 2020, the May, June, and the January, February 2021 papers that we're going to be using for revision. Then after that, what we did in the previous year is that we compiled questions and we also compiled quizzes as well. And those quizzes that you are going to be looking at, it's more like you answer the quizzes and then it will mark you, the system will mark you automatically to see if you got the answer right or got the answer wrong as well. And it will give you, there will be like a short explanation on exactly how we're getting the answer as well. So we've compiled our practice questions that we are going to be making available to you guys during the revision as quizzes that you can actually do on your own and answer, and to give you it will also mark you automatically to say if you gotten the answer right or wrong as well. So we've managed to do that during the previous year. So which means don't stress much about what we're going to be doing during revision. We have a plan for that as well. And we'll try as much as possible to ensure that we add even more material for revision so that you are able to practice as much as possible as well, apart from just looking at the 2021 papers. So that's our plan when it comes to RSK4805. Are there any questions before we go on to study unit 1?
Hi Rainos, I've got a question. Sorry, I arrived a bit late.
Yes, yes.
Is there a textbook, and is it recommended? Or which textbook is recommended?
The textbook which is recommended is Risk Management and Financial Institutions by John C. Hall. But we have the electronic version of the textbook, which we can make available to you guys as well. So we can just give you the electronic version of the textbook. But if you want the physical textbook, you can still buy the actual textbook, but we also have the electronic version that we can share with you guys as well.
Okay, so where will we get the electronic one? On your site.
Once you are registered and you're logged in, you'll be able to access it.
Okay, okay. Thanks.
But if you are not able to, just let me know so that I can share with you the link on how to access it as well.
Okay, thanks.
All right. Are there any other questions?
Did the results come out for this year? How did the people do?
They did quite well, better than expected, mainly because the concepts that we made sure that we covered during the exam period are mostly the concepts that that were asked as well. Although the few students who did fail, because we're still compiling information, because we're still getting feedback, because remember the results only came out recently, so we're still compiling the information. So sometime in the next class, we should be having the details of exactly how the previous stream did as well. Those ones we wrote in February, but they did way much better than we expected as well. Mainly because the material that was covered during the revision, that we tried as much as possible to cover in the revision, is basically mostly the concepts that we also asked in the exam. The only downside when it comes to the exam that I feel was a bit of a downside was the exam was quite detailed. There was a lot of questions that students were expected to answer, considering that some of the concepts were quite, to get to the answer, it was quite a long, it would be long calculations that I needed to do as well. So, because it's a bit of, there's also a bit of statistics that is involved to do the calculations as well. So what I would advise you is try as much as possible to master the concepts, because they expect generally, even in the previous curriculum when we're looking at derivatives as well, you'd find that a question that is asked in market risk, it's you are expected to do a long calculation, but the mark allocation there is what is also small. So you find that if you're not time efficient, if you're not efficient with your time when it comes to the exam, you end up spending a lot of your time doing complicated calculations with very little mark allocation as well. So you need to make sure that you try as much as possible to answer the questions that you know. Those questions that you've mastered and you know them, answer them as much as possible, as quickly as possible. Then go back to those concepts that you feel like you're not yet sure, 100% sure of exactly how to approach such a question as well. So the Gen-Feb exam, like what I was saying, expect that if when you're writing exam, the question, the answer, the calculations are going to be quite long calculations, but you need to make sure that you're actually time efficient when it comes to managing your time in the exam. Because most people who actually, the few people that I talked to who didn't make it, it's not like they didn't know exactly what they were doing, but it's mainly because they ran out of time to be able to answer all the questions in the exam, although the concepts, they were familiar with them. So we'll give you a more comprehensive feedback regarding that in the next class as well. Are there any other questions? So, remember what I told you, for Rsk4805, there are 9 learning units, and for study unit 1, which is covered in topic 1. So for study unit 1, which is covered in topic 1, if you check in the lecturer study guide, so if you check in the lecturer study guide for study unit 1, which is covered in topic 1, they say for topic 1 covers learning units 1 to 3 and introduces market risk management, including sources and challenges of market risk management, concepts relating to risk and return, and an overview of the financial services industry and the regular requirements for market risk management. You must first complete the short quiz at the end of the learning unit 0 before the study material for topic 1 will become available. You need to work through the study material for this topic. Therefore, you have to complete the online assessment that will count towards your year mark. So this is basically the different assignments as well. So under learning unit 1, say you have to work through chapter 1 of the prescribed textbook. Please note that if you are unfamiliar with any of the topics discussed, you have to do additional reading on your own to update your knowledge on these topics that are discussed in learning unit 1 as well. So under introduction to market risk, they say risk management is an increasingly important aspect of organizational structure. Risk management can be defined as the process of identifying, evaluating, measuring, and managing risk on a continuous basis. So risk comprises 2 categories, namely financial risk and non-financial risk, as indicated in figure 1.1. So now I'm going to highlight the figure 1.1 so that you can see. So this module focuses on the management of market risk within an organization. Within the postgraduate diploma in risk management, you will also study topics related to operational risk management, credit risk management, risk financing, and corporate governance and compliance as well, which is the other RISK modules that you're expecting to see as well. So when you look at figure 1.1, which shows you the different components which comprises risk. So this is figure 1.1, which shows us the different components which make up the risk, and you see that risk is categorized as either financial risk or non-financial risk. So typical examples of financial risk would include include a credit risk, market risk, and operational risk. Then the other components of risk, which is the non-financial risk, would now be comprised of reputational risk, legal risk, technological risk, strategy risk, operational environment risk, money laundering risk, and control risk as well. So when it comes to the exam, just know these different types of risks, but I don't really expect them to be asking you the questions in the exam directly like this. But when it comes to the assignments, this is typically what they're going to ask you in the assignments to say which one is a financial risk of the list or which one is a non-financial risk on the list as well. So you just need to be able to know, especially when it comes to answering questions in the assignments as well, when it comes to figure 1.1. Are there any questions on figure 1.1? We look at section 1.1, which looks at, so in the textbook, we're going to look at the different sections where we are going to look at the sources of market risk and the challenges in market risk as well. So which means if you look at the sources of market risk, they say market risk can be defined as the risk of loss due to the changes in the value of the underlying financial instruments held by an organization. The underlying financial instrument can be bonds, shares, loans, or commodities. There are four major types of market risk, namely interest rate risk, equity price risk, foreign exchange risk, and commodity price risk as well. Then they say the following website contains information, contains definition of the four major types of market risk that you need to read as well. So you can just go through this link on your own time, and you also go through the four major types of market risk on your own as well. But I feel like we've already discussed it, and it's going to be discussed in the textbook anyways. Then on section 1.2, yes?
Sorry, can I go back a bit on the financial, non-financial risks?
Mm-hmm.
What's control risk?
So control risk is the risk of not being able to control the operations of the organization. So it's the risk of not being able to be in control of the different operational sources of risk for the organization. That's basically what they look at when you look at control risk there.
So I would have thought that would be an operational risk then. Yeah, no, it's fine. I just found it a bit funny that it was taken out of operational risk and put as a separate risk.
Okay. So it's so you see that so it's basically not being able to be in control of the internal so it's, remember, for any organization, you need to make sure that you have the systems put in place to actually be able to now oversee the operations of the business. Like, for example, you remember what we discussed. Okay, when it comes to the risk of the organization, right? You will see that the risk manager, their job is to identify the risk and analyze the risk, and then present the risk with what to the management and the board of the company as well, right? Then the board of the company is now going to say, depending on their risk appetite, this is how much risk we're able to actually bear as an organization, isn't it? So now the control risk is now that risk where we know that, or after the management of the business say that we need to be able to stick to this particular risk so that our organization is not going to be overexposed. So it means that it comes in from the monitoring, as part of the monitoring and control activities of the risk manager, to ensure that the risk that the people or the different parties in the organization they are basically sticking to the to the risk that has been stated by the management to say this is how much risk we should be prepared to take. Like for example, if it's a financial firm, it means that control risk is that lack of having is the risk that the organization does not have control systems in place to ensure that the different parties operating within the organization are able to be monitored to ensure that they stick to the given risk limits as well. So that's basically where the control risk is going to be coming from. Are we on the same page?
Yes, it's fine. It just seems like a bit of duplication to some extent. But anyway, it is what it is. So yeah, we'll just have to learn it.
But it's also somehow linked to the operations of the organizations if you look at it effectively as well.
Thanks, Rainos.
All right. Are there any other questions? We also look at the challenges in market risk management. And here they say market risk management attempts to put a value on the risk of loss due to changes in movements in the financial market. This concept is important for all public and private organizations, not only financial institutions. So the following slides put out some of the challenges in practical market risk management as well. So when you go to this particular slide, you also see that the challenges are basically more prevalent when it comes to financial firms than non-financial firms, because with financial firms, the risk in the market environment basically changes more rapidly than for a non-financial firm as well. So you can just go through the slides and go through it by yourself at your own time as well. Then they say in the next section, we will look at various concepts relating to risk and return. So risk-averse investors want the maximum amount of return on their investment for the minimum amount of risk. So it is therefore important for an organization's management to understand the basic concepts pertaining to risk and return in order to make informed decisions on how to manage and hedge the various kinds of risk within the organization as well. Then looking at the challenges in the market risk management, let me just see. On the next section, we look at the efficient frontier. And here they say the efficient frontier shows all possible portfolios that can be created from a group of individual possibilities. Let's look at an example of the efficient frontier. So they give us an example of the efficient frontier in the next picture that I'm going to be sharing with you. And when you look at the efficient frontier, they are giving us the efficient frontier. They are giving us this as the efficient frontier, right? So the efficient frontier basically gives us this list of portfolios where you are able to maximize the return for a given level of risk, and where you are able to minimize the risk for a given level of return as well. But I'll discuss the efficient frontier in more detail when we go to the textbook as well. So you don't have to worry much about it. So we're going to be discussing the efficient frontier when I show you the example of how they approached it in the textbook as well. Then we're also going to, section unit 1.5, we're also going to be looking at the capital asset pricing model and the arbitrage pricing theory. And then we're also going to be looking at on section 1.6, the risk versus return for companies. And also 1.7, we're going to be looking at the risk management by financial institutions, and also section 1.8, where we look at the credit rating as well. So I'm not going to go through this because it's basically the same information that we're going to cover in the textbook as well. So if you check in the textbook, they tell us that on chapter 1 under introduction, second paragraph, they say the chief risk officer, as the chief risk officer, it is your job to consider how the new venture fits into the company's portfolio. What is the correlation of the performance of the new venture with the rest of the company's business? Because remember, we know that there is a relationship between risk and correlation, and there's also a relation between what? Diversification of the portfolio with correlation as well, but we'll discuss it later on. Then they say, when the rest of the business is experiencing difficulties, will the new venture also provide poor returns, or will it have the effect of dampening ups and downs in the rest of the business. So companies must take risk if they are to survive and prosper. So the risk management function primary responsibility is to understand the portfolio of risks that the company is currently taking and the risk it plans to take in the future. So it must decide whether the risks are acceptable, and if they are not acceptable, what action should be taken. And remember, how they now come up with the decision to say is the risk acceptable or not, it's based on the guideline that would have been given by the by the board of directors and the management, because those are the ones who are going to be making decisions on exactly how much risk are we going to be prepared to take as well. So on the second page of the textbook, they give us table 1.1, and table 1.1 we're going to be using it when we are now discussing the relationship between risk versus return for investors as well. So we need to find out exactly, so what is the general relationship between the risk versus return for the investors? So on section 1.1, they look at risk versus return for investors. And please note that when you look at the relationship between risk and return, the higher the risk, the higher the expected return. So when it comes to investors, when you assume that an investor is a rational investor who is risk averse, it would mean the higher the risk, the higher the expected return, which means that whenever risk increases, they also want to be compensated for that by expecting a higher return as well. So which means if that is the case, if you check just below section 1.1, they say, as all fund managers know, there is a trade-off between risk and return when money is invested. The greater the risk taken, the higher the return that can be realized. So the trade-off is actually between risk and expected return, not between risk and actual return. So what they're trying to explain there is that just because you're taking more risk does not mean that you are guaranteed that you're going to get a higher return. So the higher risk does not necessarily translate to an actual higher return, but the higher risk translates to a higher expected return, although it does not translate to an actual return as well. So which means when investors take on higher risk, they're expecting a higher return, although it does not always play that way, where they are always going to be getting that higher return that they will be expecting to get as well. So here they say, the term expected return sometimes causes confusion. In everyday language, an outcome that is expected is considered highly likely to occur. However, the statisticians define the expected value of a variable as its average value. So the expected return is therefore a weighted average of the possible returns, where the weight applies to a particular return equals the probability of that return occurring. So the possible returns and their probabilities can be either estimated from historical data or assessed subjectively as well. So what this is trying to explain is that the expected return of a single asset, so the expected return of a single asset is given as the sum of the different returns the different possible returns multiplied by the probability of earning that particular return. So for a single asset, so let me just put this across as single asset. So for a single asset, the expected return is given as the sum of the probability multiplied by the return multiplied by the probability of earning that return as well. So that's how you would be able to calculate the expected return. So now we are going to go back and see exactly how would we calculate the expected return if we refer back to table 1.1. So I'm just going to quickly highlight table 1.1 so that you can take note of the information that we have there. So if you check on table 1.1, they say over a period of a year, we're investing 100,000 in a stock, and there are different probabilities of returns and the associated return there. So there's a 5% probability that the return is going to be 50%, and there's a 25% probability that the return is going to be 30%, and then they give you all the different scenarios there as well. And please take note, your probabilities should always add up to 1. So your probabilities, if your information that you have is correct there, your probabilities should always add up to 1. So let's see how would we get the expected return of this stock if there's if you are given the probabilities, if you are given the returns and the corresponding probabilities as well. So let's see how we'll be able to calculate the expected return in this case. So to get the expected return, it would mean we're going to say, remember we say the expected return is given as the sum of the returns multiplied by the probability of earning that return as well. So which means in this case, when we say sum of, it means after we account for each scenario, we're going to be adding up the different scenarios as well, the amounts that we get for these different scenarios. So which means it's going to be given as, for the first scenario, the return is 50%. So as a decimal is 0.5. So 50%, if you want to put it as a decimal, you're going to divide it by 100, right? So 50% as a decimal is 0.5 multiplied by the probability of getting that return, which is 0.05. Plus, you go on to the next scenario, the probability, which is the return, which is 0.3 times the probability, which is 0.25. Plus, the next scenario, the return is 10%, so it's 0.1 times the probability, which is 0.4. Next, the next scenario, it's a return of minus 10%, so it's minus 0.1 times the probability, which is 0.25. In the next scenario, it's a return of minus 30%, minus 0.3 times the corresponding return, which is 0.05. So the corresponding probability, which is 0.05. So given this information, how much would you get as the expected return of this security if you put it as a decimal? How much would be the expected return then? How much do you get? How much do you get?
10%. I'm not sure if it's correct.
Is how much? You're getting how much?
About 10%, but I'm not sure if it's correct.
Yeah, so you should be able to get values of 0.025 plus 0.075 plus 0.04 plus minus 0.025 plus minus 0.015, and this will give you an amount of 0.1. And if you get 0.1 and you now multiply that by 100, this is how, to make it a percentage, this is how you get 10% as your expected return. Are we on the same page? Anyone lost? Anyone lost? So for a single asset, in this case, your expected return is given by this. Any questions? Anyone lost? Now, on the next section, we now look at quantifying risk. So on the next section, we now look at quantifying risk, and we now look to see exactly how do you determine the, how do you quantify the risk, right? Remember, we're going back to the single asset as well, right? So we look at how do you quantify the risk of a single asset. Now, in quantifying the risk of a single asset, I'm going to show you two methods so that you should know whether you're seeing one method or you're seeing the other method there. You should be knowing that you at the end of the day, you get the same answer as well. Whether you take this route of using one method or you take the other route of using the other method there, you should know that you get what? At the end of the day, you get the same answer as well. So when you're now quantifying the risk of a single asset in this case, the quantified risk of a single asset would be measured as the standard deviation of the asset. So it would be measured as the standard deviation of the returns of the asset. So the standard deviation, using the new method that some of you would not have seen before, is the one where we say the standard deviation is given as the square root of the expected value of the returns squared minus the expected return squared. So the expected value of the returns squared multiplied by the expected value of the returns squared multiplied by the expected return squared. So this component here is basically this return that we're going to be squaring there. So it's the return that we've calculated above here that we're just going to say to the power of 2. But now what we don't have is the expected value of these returns squared. So the expected value of the returns squared is given as the sum of the individual's returns squared multiplied by the probability of that happening. So it's basically given as the sum of the returns squared multiplied by the probability of that happening as well. So which means in our case, it would be equal to, for the first scenario, the return was 50% and the probability of that happening was 0.05, right? So which means it's going to be 0.5 squared multiplied by the probability of that happening, which is 0.05. That's the first scenario. So remember, we're going to be adding up these different scenarios as well, right? We go on to the second scenario. Your return is given as 30%. So it's 0.3 squared times the probability of that happening, which is 0.25. Plus the next scenario, it will be 0.1 squared times the probability of that happening, which is 0.4. Next scenario is the return of minus 0.1, so it will be minus 0.1 squared times the probability of that happening, which is 0.25, plus on the next scenario, it's minus 0.3 squared times the probability of that happening, which is 0.05. So given this information, how much do you get as the expected value of your return squared? How much do you get? How much do you get? Plus. Are we getting the same amount? Anyone lost? Is there anyone lost? So, any questions before we move on? So it means the standard deviation would be given as the square root of the expected value of your returns squared, which is 0.046 minus expected values, expected return squared, in this case as a decimal is 0.1 squared. So if you do the calculation there, how much would you get as your standard deviation? How much would you get as your standard deviation? You should be able to get a figure of 0.189737, which when multiplied by 100, so when multiplied by 100, it would give us an amount of 18.97%. So it would give us an amount of 18.97%. Is there anyone lost? Are there any questions? All right. Let me just quickly show you the other alternative method of getting the same answer using the method that I think you should be familiar with already. Is the one where we look at the variance first, where we say the variance, which is the standard deviation squared, is given as the sum of the return minus expected return squared times the probability of the return. Then you're now going to say the standard deviation is given as the square root of the variance. So this is another method that you can also use, and we're going to be using it as seeing it quite as well later on in the later chapters as well. So if you're going to be using this method, it would mean your variance would be given as, for the first scenario, remember we saw that the expected return is 10%. So it would be equal to 0.5, sorry, the 0.5 minus 0.1 squared times the probability of that happening, which is 0.05, plus, for the second scenario, it is 0.3 minus 0.1 squared times the probability of that happening, which is 0.25, plus The next scenario is going to be 0.1 minus 0.1 squared times the probability of that happening, which is 0.4. And the next scenario, it would be minus 0.1 minus 0.1 squared times the probability of that happening, which is 0.25 plus. And then the last scenario, it would be minus 0.3 minus 0.1 squared times the probability of that happening, which is 0.05. So this is another method that I feel you should be familiar with, which will also take you to the same answer of getting the variance as well. So if you use this method, how much are you going to get there as your variance? How much do you get? So you should be able to arrive at a variance of 0.036. So you should be able to arrive at a value of the variance being equal to 0.036. Is anyone lost? Any questions? Anyone still a bit behind? Anyone a bit behind? Anyone lost? Anyone lost or anyone a bit behind? Which means the standard deviation is going to be the square root of 0.036. And if you look for the square root of 0.036, you will get an amount of 0.189737, which is equals to 18.97% if you multiply this amount by 100. So if you multiply this amount by 100 to make it a percentage, you get 18.97%. So do you see that whether you use this method or you use that method, it will still take you to the same answer at the end of the day?
Rainos?
Yes?
When you do the calculation, is it advisable to do like a bit at a time so that you can have each of the answers and then add them all up instead of just trying to do it all on the calculator and coming up with one answer?
You can try to do them all in the calculator, but if you miss a bracket, it means you're going to get the answer totally wrong. So it's entirely up to you. But if you're afraid of making mistakes, rather break it down to different calculations and add them up together as well.
Okay.
Another way that you can use to make your life a bit easier, especially for those who are using the HP calculator to do this, the normal to do these calculations, you can store your answers in memory as well. So whenever you do part of a calculation, like for example, you can break it down into, say, this is the first component, the second one, the third one, the fourth one, and the fifth one. Then whatever you do as a calculation here, you store it in memory, you go on to the next one, and the next one, and the next one, and the next one, then you add them up together. But if you put it all at once, for those who are using the sharp financial calculator or the normal scientific calculators, try to make sure that you're not missing a bracket or anything, because if you miss one thing, you get your answer totally wrong. Any questions? Are there any questions? So for a single asset, this is typically how you determine the expected return of a single asset. And this is how you can determine the standard deviation of a single asset as well. Any questions before we move on? Section 1.2. Section 1.2 looks at investment opportunities. So section 1.2 looks at investment opportunities. And when we look at investment opportunities, this is basically the plot of the different risks that the investors would be taking against what the expected return. So you can plot the different risks that the investor would be taking against what the expected return, depending on exactly how much are the different variables that are going to be taken into account that is going to be accounted for to get the what to be able to upload the investment opportunities as well. So which means you are basically plotting the corresponding standard deviation to the corresponding expected rate as well, so that you're able to see exactly roughly how much are we expecting to be the relationship between the risk and return for a particular portfolio of securities or for a particular asset as well. So given this information, now we need to find out exactly, so how do you determine the expected return and the standard deviation of your portfolio of securities? So we are now going to look at to see exactly how do you determine the expected return and the standard deviation of a portfolio of securities as well. So for a portfolio of securities, remember a portfolio of securities, whenever you are now having two or more securities, you are now having a portfolio of securities there, right? So now for your portfolio, now for simplicity's sake, we look at the portfolio of securities by assuming that you have a two-asset portfolio. So in our simplified calculation of the standard deviation and the expected return of a portfolio, we assume that you are having what? A portfolio of two securities. So if it's a portfolio of two securities, now we need to find out exactly, so how do you determine the standard deviation of this portfolio of securities as well? So what do we see? It means if the expected return of the portfolio is given as the sum of the returns multiplied by the weights of the returns. So the sum of the returns of the individual assets times the weight of the returns of the individual asset. And this will give you the expected return of the portfolio. So which means if you are having a two-asset portfolio, it would mean your expected return is going to be the return, it would be the expected return of asset one times the weight of asset one plus the expected return of asset two times the weight of asset two. So if it's a two-asset portfolio, it means that it's going to be the expected return of asset one times the weight of asset one plus the expected return of asset two times the weight of what? Of asset two. So if it's a two-asset portfolio, this is how you would determine the expected return of that portfolio. And also, please take note, just like probabilities, weights always add up to 1. So just like probabilities, weights always add up to 1. So if that is the case, it means the weight of asset 2 can also be given as 1 minus the weight of asset 1. So if it's a two-asset portfolio, the weight of asset 2 can also be given as 100%, which is 1 minus the weight of asset 1. Or in case you are given the weight of asset 2, but you don't have the weight of asset 1, it also means that the weight of asset 1 is also given as 1 minus the weight of asset 2, because remember, the weight of the assets which makes up your portfolio, of your two-asset portfolio, should always add up to what? Up to 100, which is 1. Are we on the same page? Any questions? Now, for your portfolio, the standard deviation of the portfolio would be given as the square root of weight of asset 1 squared times the standard deviation of asset 1 squared plus the weight of asset 2 squared times the standard deviation of asset 2 squared plus 2 times the weight of asset 1 times the weight of asset 2 times the correlation coefficient between asset 1 and 2 times the standard deviation of asset 1 times the standard deviation of asset 2. So what you are finding at the bottom there is where you are referring to either asset 1 or asset 2, and on the powers there, this is basically where I'm saying on the subscript, this is basically referring to the different assets, and on the superscript, this is where you are referring to the what? To the putting to the power of 2 there. So it's basically referring to the power of something. So this is how you find the standard deviation of a two-asset portfolio. So if you are asked to find the standard deviation of a two-asset portfolio, this is how you would find the standard deviation of a two-asset portfolio. Please take note as well that the correlation of asset 1 and 2 times the standard deviation of asset 1 times the standard deviation of asset 2 gives you the covariance between asset 1 and 2. So the correlation, so this means correlation coefficient. So the correlation between asset 1 and 2 times the standard deviation of asset 1 times the standard deviation of asset 2 gives you the covariance between asset 1 and 2. So it will depend on exactly what information they give you. If they give you the covariance, it means when you're finding the standard deviation there, they've already done this part of the calculation for you. So you just put in whatever amount that they give you as the covariance. If they don't, it means that if they only give you the correlation coefficient, it means you need to account for the standard deviations of the two assets there as well. Any questions? Now, let's go back to the textbook on page 4 of the textbook, right? The last paragraph of page 4 of the textbook. So the last paragraph of page 4 of the textbook, they give us that information. And on this, they say, on the last paragraph, they say, suppose that mu, so whenever they refer to mu, is basically the expected return. So whenever they are referring to mu, they are referring to the expected return. So the mu is basically the expected return. So which means in this case, this would be referred to as the mu. So this is the expected return of asset 1, and this is the expected return of asset 2. So if the same mu, which is given by this sign, it's basically looking at the average return of a single asset as well. So you should know they're talking about one and the same thing as well. So if you check here, they say, suppose that mu is 10% for asset 1, and the standard deviation for asset 1 is 16% per annum, while for the mu, which is the expected return for asset 2, is 15%, and the standard deviation is 24%. Suppose also that the correlation coefficient of the between the returns is 0.2. Table 1.2 shows us the values of the mu of the expected return and the standard deviation for a number of different values of the weights that are given for asset 1 and asset 2, right? So they give us table 1.2. So table 1.2 is what they're giving us here. So this is table 1.2 that they're giving us. So what I'm just going to do is I'm just going to quickly demonstrate how you would typically calculate the expected return of the portfolio and the standard deviation of the portfolio given the different weights as well. And what I'm going to demonstrate in the on the board is how they are getting these, given that the weight of asset 1 is 0.4 and the weight of asset 2 is 0.6. How do we get the expected return of the portfolio being 13%? And how do we get the standard deviation of the portfolio being 16.89%? So I'm just going to demonstrate how we're getting these values, given that we are given that the weight of asset 1 is 40% and of asset 2 is what? 60%, which is 0.4 and 0.6 there. All right. So given this information, it would mean the expected return of the portfolio would be given as, remember, is the sum of the return of asset 1 times weight of asset 1 plus the return of asset 2 times weight of asset what? 2. So what do we see? They are telling us that the expected return for asset 1 is 10%. So it's going to be 0.1 times the weight of asset 1. We saw that in the scenario that we're given, they're giving us different scenarios of different weights. But in the scenario that we're looking at, we are assuming that the weight of asset 1 is 0.4, which is 40%. Plus the return of asset 2, where the expected return of asset 2 was given as 15%. So it's 0.15 times the weight of asset 2, which is 0.6. So given this information, how much would we get as the expected return of the portfolio? How much would you get there? How much do you get?
13%.
So it will be 13% because it's 0.04 plus 0.09, which would give us an amount of 0.13. And then if you multiply that by 100, to make it a percentage, you get an expected return of 13%. Any questions? Anyone lost? Any questions? Is anyone lost? Then, given this information, we also need to find out exactly how much would be the standard deviation of these two asset portfolios. So we also need to be able to find the standard deviation of these two asset portfolio. So for these two asset portfolio, the weight of asset one, we know that the weight of asset one is 0.4 squared times the standard deviation of asset one. We were given that for asset one, the standard deviation is 16%, so it's 0.16 squared, plus the weight of asset 2, which is 0.6 squared times the standard deviation of asset 2, where on the information that we're given, the standard deviation of asset 2 was given as 24%, so it's 0.24 squared, plus 2 times the weight of asset 1, which is 0.4, times the weight of asset 2, which is 0.6, times the correlation coefficient between the two assets. And this, remember they say, assume that the correlation coefficient is 20%, which is 0.2. So it's 0.2 times the standard deviation of asset 1 and 2, which is 0.16 times 0.24. So given this information, how much would you get as the standard deviation of your portfolio there? How much do you get?
Zero 0.285. 0.0285, yeah. Not sure if it's correct.
Okay, so you will be able to get a figure of so you'll be able to say 0.004096 plus 0.020736 plus 0.003664. And this will give us an amount of, so we'll be looking for the square root of 0.0285184. And the square root of that would give us an amount of 0.168874. And then if you multiply that by 100, so if you multiply this by 100, that's when you're able to get a figure of 16.89% being your standard deviation. Are we on the same page? Anyone lost?
So far, so good.
Okay. Now, this is typically how you'd calculate the expected return of the portfolio and the standard deviation of the portfolio, right? So now we need to find out exactly, so what happens to the expected returns of these portfolios when you look at the standard deviations of these portfolios as well, right? So we're going to go back and look at table 1.2. And when you look at table 1.2, you see that for if you allocate 0 to weight to asset 1 and 100% weight to asset 2, the expected return of the portfolio will be 15, and the standard deviation of the portfolio will be 24. And if you do the different allocations there, they give you the corresponding expected returns and the standard deviations. Are we on the same page so far? So these are the corresponding expected returns and the standard deviations given the different scenarios as well. Right? Now, given this relationship, we can now be able to plot this information. Just slow it a little bit. So given this information, we can now be able to plot this information on a graph, which is figure 1.2. So for example, for an expected return of 10%, we see that the corresponding standard deviation is somewhere at 16% there, right? And for an expected return, in this case, the highest expected return is an expected return of 15%. And for an expected return of 15%, we see that the corresponding standard deviation would be somewhere at 24% there. So do you see that we are now plotting the expected returns against the corresponding standard deviations, right? So we are now plotting the expected returns against the corresponding standard deviations, right? So we're plotting the expected returns against the corresponding standard deviations there. Are we on the same page? So that's basically what they are now doing when you look at table 1.2 and figure 1.2. Any questions? So the plot of this information brings us to the discussion of the efficient frontier. So the plotting of the expected returns against the standard deviations there leads us on to the discussion of the efficient frontier. So it leads us on to the discussion of the efficient frontier, right? So with the efficient frontier, we now need to find out exactly, so what happens to the expected returns that we have plotted here, that we have plotted against what the given standard deviations there as well, right? So when you look at the efficient frontier basically plots the expected returns against the different standard deviations there, right? So let me just draw the graph that we are looking at here in a simplified way as well. So if you look at the graph of the information that we're given, we are plotting the expected returns against the standard deviations. So we are plotting the expected returns against the standard deviation. And the information that we're having is that we are coming up with a graph which is more or less something like So we're coming up with a graph which is more or less something like this, right? So we're coming up with a graph which is more or less something like this. So our graph is roughly plotting as something like this. So this is the graph that we have there, right? Now, what do we see? It basically means that there's something that we have to take into account when we look at investment returns. Because remember, there is for a certain amount of risk that we're taking, there's a certain investment return that we also need to account for there as well. So effectively, when you look at the efficient frontier, the idea behind the efficient frontier goes back to the relationship between risk and return. So the idea behind the efficient frontier, it goes back to the relationship between risk and return. What do we know about risk and return? Remember we said that for a rational investor who is afraid of taking on more risk, whenever they take on more risk, they want to be compensated by getting what? A higher expected return. So for a normal investor who's afraid of taking on risk, for every additional unit of risk that they take, they want to be compensated by getting a higher return as well. So which means, if you look at our graph here, let's call this investment. Let me see how the lecturer puts it in the efficient frontier. So let's call this I'm going to put another investment here, because another relationship of investments can be found also somewhere there as well, right? So it can be found somewhere. Can be found roughly somewhere there as well, right? So how the lecturer is plotting it, it's either plotting it like this or plotting it like that as well, right? So if you look at these points, my graph is going to be a little bit different from what the lecturer has given us, but it's still going to explain more or less the same thing as well. So we have point A, point B, point C. Okay, let's call this point D as well, right? So we have point A, point B, point C, and point D there as well, right? Remember what we said, when it comes to risk and return relationship with investments, you want to maximize the return for a given level of risk, and you want to minimize risk for a given level of return. So when it comes to investment, that's your goal, isn't it? You want to maximize return for a given level of risk, and you want to minimize risk for a given level of return. My graph is slightly different from what they're explaining in the textbook, but it basically goes back to the same principle as well. I just manipulated a little bit so that you can see what I'm trying to demonstrate when it comes to the relationship between the risk and return relationship there. So if you check on our graph, what it means is that if we look at this relationship, if you are going to be comparing point A and point C, so if you're going to be comparing point A and point C, where A, you're exposed to this amount of risk, point C, you're exposed to this amount of risk as well. What would that mean? Where would you rather invest? Investing in A or investing in C?
Invest in A.
So you'd rather invest in A, isn't it, right? So you'd rather invest in A. And so you'd rather invest in A here, isn't it, right? Now, if you're comparing point B, C, and D, So if you're comparing point B, C, and D, where would you rather invest?
In B.
In B, right? So you'd rather invest in B. The reason why you'll be making these decisions is mainly because if you are looking at these different investment points, what do we see? We see that when you're comparing A and C, for the same amount of return, A is exposed to what? To less risk, isn't it? So for the same amount of return, A is exposed to less risk. And then if you're comparing B, C, and D, what do we see? For the same amount of risk, B is giving us the what? The highest return. So for the same amount of risk, B is giving us the highest return. Are we on the same page then? So overall, if you're going to be plotting the efficient frontier, your efficient frontier would roughly be something along this line. So it would be roughly be something along this line. Because we're basically saying that the efficient frontier is the list of portfolio combinations where you are able to maximize the return for a given level of risk or minimize the risk for a given level of what? Of return. So that's basically what they mean by efficient frontier. Any questions?
Rainos?
Yes.
So point D would not then be on the efficient frontier.
It's not going to be on the efficient frontier, mainly because you are better off investing in portfolio B combination than what? D. Why? Because for portfolio B there, for the same amount of risk, portfolio B is giving you the highest return.
Thanks.
Are we together? Any questions? Any questions? Out of interest as well, out of interest, if you are asked to choose between point A or point B, your choice, do you see that we're saying that point A and B, they are all found on the efficient frontier, isn't it? Which means when it comes to the efficient frontier, points or investment portfolios found on the efficient frontier, your choice of the investment portfolio depends on your risk appetite. So it depends on the investor's risk appetite. If the investor has a higher risk appetite, they are going to invest in portfolio B. And if the investor has a lower risk appetite, they're going to invest in portfolio A. So it will depend on exactly what is the risk appetite of the relevant investor in this case. Looking at page 7 of the textbook, it shows us the efficient frontier if you are assuming that you can borrow at the risk rate of return and invest in a risk-free portfolio as well. So if you're assuming that you can borrow at the risk rate of return and invest in a certain portfolio, you now need to find out exactly how would you come up with the given efficient frontier there as well, right? So if you check on figure 1.4, they say, when you look at the efficient frontier of all investments, they say point I, which is basically this point, is achieved by investing a percentage BI of available funds in portfolio M and the rest in the risk-free investment. So which means that if you're going to be investing some of your investments in a certain portfolio and some of your investments in a risk-free investments there, that's how you're going to be able to achieve a certain return, which is basically at this point I as well. Then they also say point J is achieved by borrowing B and J minus 1 of available funds at the risk-free rate and investing everything in portfolio M. So which means that if you want to be able to achieve an investment which gives you a higher rate of return of this investment J, it would basically mean that you are going to be investing some of your investments, you are going to be giving more weight to some of your investments in a particular portfolio which will give you a certain expected return, and the rest of your investments, you are going to be investing them in portfolio M, so that when you're able to now get the overall return of your investment there, your efficient frontier is going to be something like that. So which means that the assumption behind the efficient, this line of the efficient frontier is basically that you are able to borrow or invest the available funds at the risk rate of return. So it would now, the return of the portfolio that you're going to be earning there would depend on exactly how much weighting are you allocating to a particular portfolio that you're expecting to a particular asset that you're expecting to get, so that you're able to actually get an overall higher rate of return compared to what you would have earned at the risk on the efficient frontier there. So if you want to earn a return which is above what you can earn on the efficient frontier, it basically means that you're going to be borrowing at the risk rate of return and investing a certain percentage in a particular risk-return relationship, so that at the end of the day, you're able to have an efficient frontier, which is something like that. So how this efficient frontier would now be achieved is where we are assuming that your portfolio would be completely diversified. So the assumption there of how you're able to achieve this efficient frontier is that your portfolio is completely diversified. So what do we mean by a portfolio that is completely diversified? If you check now, it would mean when you look at the risk of a portfolio, we say the total risk of a portfolio is given as your systematic risk plus unsystematic risk. And the systematic risk in this case is also referred to as the so the systematic risk in this case is also referred to as the non-diversifiable risk. And the unsystematic risk is also referred to as the diversifiable risk. And if you look at the risk of a portfolio, your total risk is measured using the standard deviation. And then your systematic risk is measured using the beta. So your total risk is measured using the standard deviation, and your systematic risk is measured using the standard deviation. So for you to be able to get a return which is over and which is floating above what you could have earned on the efficient frontier, it basically means that the assumption that we're talking about there is that this diversifiable risk would have been done away with, and you're only going to be left with what? With systematic risk. So this can also be plotted in as something like this. So which means this is where we're saying, if you look at the total risk of a portfolio, so we're saying that the total risk of a portfolio, if you look at how it plots, we're basically saying that can be plotted as something like this, where we're saying, here we have the number of securities, number of securities. So we have the number of securities, which means we're basically saying that when you look at this relationship, the more number of securities that you are having that are different in your security, the more this total risk is going to be reducing. So which means of this total risk that is going to be reducing, this risk which reduces until it goes here up to here, is this amount of risk is what we refer to as diversifiable risk. So this would be your diversifiable risk, because we're basically saying that this is the risk that is going to be reducing as the number of securities that you're having in your portfolio is increasing. Then when the diversifiable risk reduces up to 0, this is the point where you are only going to be left with what? Non-diversifiable risk. So which means the only risk measure that you're going to be left with there after everything is a situation where you are now having what? A fully diversified portfolio where the only risk you're going to be worrying about is the beta, which means your total risk of the portfolio is no longer going to be looking at or assessed based on the standard deviation, but it's going to be based on the what? Beta there. So that's how you are now going to be able to achieve a risk-return relationship which is going to be plotting above the efficient frontier. So taking that into account, now we need to find out exactly, so how do you look at the risk-return relationship that is based on the assumption that your diversifiable risk has been done away with and you're only going to be left with what? With the beta. So we're now going to see exactly how do you look at this risk-return relationship where the diversifiable risk is going to be done away with and you're only going to be left with what? The beta of the portfolio, the beta as well, right? So which means one concept which takes into account the assumption that your portfolio is fully diversified and the only risk that is going to be left in this particular portfolio is your systematic risk, is the capital asset pricing model. So when you look at the capital asset pricing model, if you check on section 1.3, so if you check on section 1.3, they discuss the capital asset pricing model. I'm just going to quickly discuss what they're talking about here. Then we go back to, then we look at the how the formula, how we can look at section 1.3, where we are now going to be discussing to see exactly how do they come about with the formula for the capital asset pricing model as well. So here on section 1.3, they say, a common procedure is to use historical data and regression analysis to determine a best fit linear relationship between the returns from an investment and returns from the market portfolio. So this relationship has the form where the return is given as A plus beta multiplied by the market return, multiplied by the market risk premium, market return on the multiplied by the market return, the return on the market portfolio times an error term there, or random term as well, right? So where they say R is the return from the investment, RM is the return from the market portfolio, A and B are constants, and E is the random variable equal to the regression error as well. So looking at these, if you go to page 9, saying two uncertain, so equation 1.3 shows that there are two uncertain components to the risk in the investment return. The first one is that a component of beta times RM, which is the multiple of the return from the market portfolio, and the second component is the error term, which is the unrelated to the return from the market portfolio as well. So here they're saying the first component is referred to as the systematic risk. The second component is referred to as the non-systematic risk. So, so consider first the non-systematic risk. If we assume that the error variable from the different investments are independent of each other, the non-systematic risk is almost completely diversified away in a large portfolio. So an investor should not therefore be concerned about non-systematic risk and should not require an extra return above the risk-free rate for bearing non-systematic risk. So the systematic risk component is what should be and what should matter to an investor. So which means they are basically saying that if the investor is a large portfolio, it means that we're assuming that they are fully diversified. And if they are fully diversified, the only risk that they have to worry about is the systematic risk, not the non-systematic risk. So if that is the case, it would mean the expected return of the security would now be given as your risk rate of return plus the beta multiplied by the expected return in the market minus the risk rate of return. And this is what they refer to as the capital asset pricing model. So the components on the capital asset pricing model can also be plotted on a graph as you are seeing on figure 1.5. So the components of the Kepler asset pricing model can also be plotted on the graph there, right? And as you can see, if you check on the components on how they are plotting this graph, they are giving us that the graph would be something like this. So this is the graph which shows us the relationship between the expected return and the beta. Remember, we're saying that this graph assumes that you are looking at a situation where you are able to invest in a portfolio where the standard, the systematic risk has been done away with, and the only measure of risk that you're going to be concerned with what is the beta there. So if that is the case, it would mean you're also saying that for a certain, you can also earn a certain return without incurring any risk at all. So there's a possibility that you can also earn a certain return without incurring any risk at all. Then if you invest in the market, so investment in the so when you look at investment in the market where you are getting the market return, so investment in the market where you are getting the market return, the assumption is that the beta in the market is always going to be equal to 1. So please take note, the assumption is that with the capital asset pricing model, if you invest in the market where you're getting a return in the market, you're assuming that the beta in the market is always going to be equal to 1. Then if you invest in the asset, that's when you're going to be able to now get the asset return there, right? And how do you determine the asset return? The asset return is now going to be given as the expected return of this asset would be given as the risk rate of return plus beta multiplied by the market return minus risk-free rate of return. So this is how you're now going to be able to plot this information so that you're able to what? To plot this graph which shows the relationship between the expected return and the beta, where we are saying that the assumption here is that your portfolio is going to be fully diversified. And if it's fully diversified, the only relevant measure of risk that is going to be taken into account would be the beta. So when you look at the capital asset pricing model, this is how you would plot the risk-return relationship when you look at the capital asset pricing model there. Are there any questions? So based on this formula for the capital asset pricing model, they give us example 1.1. So they give us example 1.1. I don't think calculations of these amounts would be something very complex, because if you look at example 1.1, they say, suppose that the risk rate of return is 5%, the return on the market portfolio is 10%, an investment is a beta of 0, and should have an expected, so if an investment with a beta of 0, how much should the expected return equal to, right? And if the investment is a beta of 0.5, how much should the expected return be equal to as well? And if the investment is a beta of 1.2, how much should the expected return be equal to? So if you check, what they're trying to explain here is that based on this formula, when the beta is equals to 0, the expected return would be equal to the risk rate of return, which is 0.05, plus the beta of 0 multiplied by the market return of 0.1 minus 0.05. And you see that this would give us an amount of 0.05 plus 0, which is equals to 5%. Because if you multiply that by 100, that's how they're saying that the return would be 5% there as well. So in this next scenario, they're saying that if the beta is equals to 0.5, it would mean that the expected return based on the capital asset pricing model is going to be 0.05 plus 0.5 times 0.1 minus 0.05. And if this is the case, it would mean that your answer is going to be 0.075, which is equal to 7.5%. So this is how we're now going to be able to deduce the expected returns given the assumptions of the different betas as well. Is there any question? Now, we also go on further to see exactly, so how do you determine this beta of the security, right? So we also go on further to see exactly how do you determine this beta of the security when you look at the relationship between the return in the market and the return in the assets as well, right? So take note of this, that the beta of a security is given as the correlation coefficient between the security I and the market multiplied by the standard deviation of the security divided by the standard deviation in the market. So the beta of a security is given as the correlation coefficient between the asset and the market multiplied by the standard deviation of the asset divided by the standard deviation of the market. So that's the general relationship that you need to make sure that you take note of on how you would actually get the beta of a particular security, in this case, security I. Are we on the same page?
Rainos,
Mm-hmm.
is the symbol for the correlation coefficient like P? Is it a P?
Yeah, but in actual fact, it's something like this. It's something like this.
Oh, okay.
Yeah.
It's a P with a crooked tail.
Which is a bit crooked like that, yeah.
Okay, thanks.
Now, when we looked at the risk-return relationships that we've been looking so far, like when you look at figure 1.4, there are certain assumptions that have been made regarding the analysis of the market and the investors as well. So if you check on section 1.3.1, you might need to just take note of the different assumptions that we take into account. And yet the same, the reasons why the analysis leads to conclusions that do not correspond with the realities of markets is that in presenting the arguments, we implicitly made a number of assumptions. So there are a number of assumptions that were made when it comes to the models that we're looking at in calculating the expected return of the portfolio. And the first assumption is that we assumed that investors care only about the expected return and the standard deviation of their portfolio. So they are not worried about exactly what are the other elements that can also affect what the performance of their portfolio as well. Then the next one is on page 11, we assumed that the error variable for different estimates, for different investments in equation 1.3 are independent. So we assume that there's no relationship between the error variables with the performance of the different securities as well. Then number 3, we assume that that investors focus on returns over just one period, and the length of this period is the same for all investors. Then number 4, we assumed that investors can borrow and lend at the risk-free rate. So this is approximately true in normal market conditions for a large financial institution that has a good credit rating. But it is not exactly true for such financial institutions, for such financial institutions, and not at all true for small investors. So we also assumed that we also did not take into account what? Tax. Then lastly, we assumed that all investors make the same estimates of expected returns, standard deviations of returns, and correlations between returns of available investments. To put this another way, we assumed that investors have homogeneous expectations. So we're assuming that investors have the same expectations when it comes to the expected returns, the standard deviations, and the correlations as well. Any questions before we look at the calculation of the alpha? So when you look at your alpha is your excess return. So when you look at your alpha is basically your excess return. So when you're calculating your excess return, it basically means that your alpha is which is your excess return. So what do we know? We know that when you look at the capital asset pricing model, the expected return of the portfolio is given by that, right? So which means if the expected return of the portfolio is given by that, this means that your alpha is basically the excess return, where you're saying, if you look at the performance of your portfolio, how is it done compared to how much you were expecting the returns to be as well. So which means your alpha, which is your excess return, is given as the return of the portfolio minus the expected return. So it's the return of the portfolio minus the expected return. So it's the return of the portfolio minus the expected return. And what do we know about the expected return? It will be the return of the portfolio minus your expected return, which is given. Remember, the expected return is calculated by the capital asset pricing model, would be the risk rate of return plus beta, the market return minus risk-free rate of return. So this is basically how you would calculate your alpha. So if you check in the textbook, the formula that you're just showing you there, it's nothing new. There's nothing totally new there. The only thing that they're giving you is where they are now simplifying this graph. Or sorry, simplifying this equation. Because if you simplify this equation, it means, remember, you're assuming that your coefficient here is 1, right? Outside the bracket, you're assuming that the coefficient is 1, which means that it's going to be return of the portfolio minus 1 times RF gives you minus RF. Minus 1 times beta gives you minus beta multiplied by what's in that bracket, market return minus risk-free rate of return. So this, when they now put it in the expanded version, it comes out like this, but it's still going back to the component, to the point where we say your alpha is your expected, your excess return. And if your excess return is saying how much did the portfolio perform compared to what you were expecting it to perform. Did it overperform or did it underperform? If it overperforms, it means your alpha will be positive. So if the portfolio overperforms, your alpha will be positive. And if the portfolio underperforms, your alpha will be what? Would be negative as well. Are we together? Now, so far, we have assumed that to get the expected return, we take into account the risk rate of return, but we've assumed that the only risk factor relevant using the capital asset pricing model is the beta. And here, base is going to be the risk factor is going to be multiplied by the excess of the market return and the risk rate of return. And this is how you're going to be able to get what? The expected return. But now, there are other models which are used to get the expected return. And one model that they talk about, which is used to get the expected return, although we are not going to go through it in detail, is the arbitrage pricing theory. So they just discuss it in the textbook, but they don't go through it in detail as well. So if you check in the textbook, they say The arbitrage pricing theory can be viewed as an extension of the capital asset pricing model. In the capital asset pricing model, an asset's return depends on just one factor. So in arbitrage pricing theory, the return depends on several factors. So these factors might involve variables such as gross national product, the domestic interest rate, and the inflation rate. So by exploring ways in which the investors can form portfolios that eliminate exposure to the factors, arbitrage pricing theory shows the expected return from an investment is linearly dependent on the factors as well. So which means when it comes to arbitrage pricing theory, they are basically saying that there are other factors that you have to take into account. You are not only taking into account that the only risk factor that you're going to be taking into account when, like, for example, if you look at the capital asset pricing model, is going to be dependent on the risk multiplied by the what? The beta multiplied by the what? The excess of the market return and the risk rate of return as well. Section 1.5, they look at the risk versus return for companies. And here they say, we now move on to consider the trade-off between risk and return made by a company. How should a company decide whether the expected return on a new investment project is sufficient compensation for its risks? So if you skip the next paragraph, they say the argument just given suggests that non-systematic risk should not be considered when accept or reject decisions on new projects are taken. So in practice, companies are concerned about the non-systematic as well as systematic risk. So which means, remember we said that if you assume that you are living in a world where your securities are fully diversified, that's when you can use the beta or take into account the systematic risk. But we know that in practice, companies also need to take into account all the different sources of risk. Hence, they are saying that when you look at the risk-return relationship for companies, they try as much as possible to take into account both systematic and non-systematic risk. So, with that in mind, we now look at the different issues that needs to be taken into account when it comes to the risk-return relationship between for a company as well. And the first issue that needs to be taken into account is the bankruptcy costs, right? And when you look at the bankruptcy costs, they say right at the bottom of page 16, on line number 5, they say, when expected bankruptcy costs are taken into account, projects that have a high total risk are liable to be rejected as unacceptable. So this explains why investors like companies to limit the overall amount of risk they take and reward companies that manage risk so that they meet earnings forecasts as well. So to understand this better, on your own time, can you please have a look at Business Snapshot 1.1 to see exactly what are the hidden costs of bankruptcy when it comes to a company as well, because there are so many other implications that comes into play when a company is facing what? A bankruptcy as well. So please have a look at Business Snapshot 1.1. The other issue that you have to take into account when you look at the risk-return relationship for companies as well is to do with financial institutions, where they say one can argue about how important bankruptcy costs are for the decision-making of a non-financial company, but there can be no questions about that is crucially important for a financial institution, because such as a bank, to keep its probability of bankruptcy very low. So large banks rely on wholesale deposits and investments such as commercial paper for their funding. So which means confidence is the key to their survival, mainly because if there's a lack of confidence in the financial system, it basically means that now there's going to be a run for money by the depositors as trying to withdraw their money, and at the same time, because the bank would have actually used that money to invest in other things as well, it basically means that the bank is now going to have a situation where they are now going to fail to meet the depositors' needs when they run for the bank trying to access the money as well. And now this will end up having a ripple effect, which will end up affecting the whole financial system as well. That's why you see that whenever there's a run for money by depositors on a particular bank, the central bank usually gets involved to try to instill confidence in the financial system as well, like what you've seen with VBS Bank. Then on section 1.5.3, we also look at issues of regulation, where they say even if, in spite of arguments that we have just given, the managers of a bank wanted to take huge risks, they would not be allowed to do so. Unlike other companies, many financial institutions are heavily regulated. So governments throughout the world want a stable financial sector. So it is important that companies and private individuals have confidence in banks and insurance companies when they transact business. So the regulations are designed to ensure that the probability of a large bank or an insurance company experiencing severe financial difficulties is low. So the bailouts of financial institutions in 2008 during the subprime crisis illustrate the reluctance of the government to let large financial institutions fail. So regulated financial institutions are forced to consider total risk, not just the systematic risk, which means that they have to take into account both systematic and non-systematic risk as well, so that they also account for all the risks that the institution is going to be facing to ensure that there's low probability of bankruptcy when it comes to those security institutions as well. Then on section 1.6, we also look at risk management by financial institutions, and here they say there are two broad risk management strategies open to a financial institution. One approach is to identify the risk one by one and handle each one separately. This is sometimes referred to as risk decomposition. The other is to reduce risk by being well diversified. So this is sometimes referred to as risk aggregation. So both approaches are typically used by financial institutions when they're managing the risk as well. Then lastly, on section 1.7, we also take into account credit ratings. And here they say the credit rating agencies provide information that is widely used by financial market participants for the management of credit risk. So a credit rating is a measure of the credit quality of a debt instrument, such as a bond. So however, the rating of a corporate or sovereign bond is often assumed to be an attribute of the bond issuer rather than the bond itself. So thus, if the bonds issued by a company have a rating of AAA, the company is often referred to as having a rating of AAA as well. So when it comes to the actual ratings by the different by the three major rating agencies, they don't really worry much about them. Just know that the different the different companies that issue securities, that issue bonds or securities, they are also given credit rating, whether usually the credit rating varies between A, B, C, and D, where D is basically the ones that are considered to have defaulted, and A are those good quality, and they now categorize them depending on exactly the amount of quality that is attributable to these different entities as well. So this is where we are going to end when it comes to today's class, because we have done chapter 1. Is there any question from chapter 1? Anything that you found difficult that you might need me to explain a little bit further? Any questions?